Good morning, good afternoon, good evening. Whenever you're taking the time to watch this, thank you for joining me. This is the July 2026 Zenith Portfolio Market Update. Now, this is the first month in quite a number of months where the portfolios overall are down. Now, the main reason for this is back again to the US and Iran conflict. When I had this conversation to the camera last month and the month before, things were starting to subside and a ceasefire agreement was made. However, in the last month, the fighting has resumed and both sides have started causing issues once again with the Strait of Hormuz, attacking ships and causing that strait of water to be effectively inaccessible and unpassable for some really important cargo, namely oil. The oil price has gone from less than $70 per barrel back up to over $80 per barrel as of this morning, and today's date is the 31st of July. And this is important because, as mentioned in previous videos, the price of oil impacts inflation and basically the costs of goods and services in all manner of ways. And once again, inflation has been a leading cause of market uncertainty over the last 2 to 3 years. Rising inflation means that central banks try to combat this with rising interest rates. So not only does the price of goods and services increase, but the cost of borrowing does as well. And this is generally negative for the economy. For the month of July, the Zenith Cautious Portfolio, the 1 out of 5, has delivered a minus 0.94% return. And the Global Capital 5 out of 5, or the highest risk portfolio, has delivered a minus 2.22% return. Now, this is on a single month basis, and as we are all aware, investing is for the long term, and we can measure performance over a monthly basis, but it doesn't necessarily impact whether or not an investment is good or bad. The key thing with any good quality portfolio is that over the long term, the quantity of positive months outweighs the quantity of negative months, delivering a positive overall return. And this is exactly what we've had on a 12-month basis. One phrase that I like to use in this scenario is, if in doubt, zoom out. And what we mean by this is we can look at a month in isolation and it doesn't tell us very much. But if we take a step back and look at investing markets and the portfolios over a longer period of time, this starts to build a clearer picture. Over the last 12 months, the Zenith Cautious Portfolio, the 1 out of 5, has delivered a return of 7.13%. The Income Portfolio, the 2 out of 5, has delivered a return of 10.34%. A Balanced Portfolio, or 3 out of 5, has delivered a return of 12.95%. The Growth Portfolio, or 4 out of 5, has delivered a return of 15.45%. And the Global Capital Portfolio, the 5 out of 5 portfolio, has delivered a return of 18.08%. Now, these returns are inclusive of the recent pullback in valuations. So even over a 12-month perspective, a short-term pullback within the portfolios is normal. All 5 portfolios are behaving exactly as you would expect them to do, given the events that have occurred over the last month. Moving forward, we're still seeing really good earnings reports coming out of companies. Companies are becoming more and more profitable, and their underlying earnings are growing at really good rates on average. This is the most important factor in driving long-term stock market returns. Now, there are obviously some underlying considerations within the market at the moment. People are very cognizant of interest rates. They are very cognizant of inflation. And this is, of course, something that we are paying close attention to as well. Moving forward, and in an ideal world, we will see a swift rectification of the issues between US and Iran, and hopefully that conflict will start to subside so we can remove some of the uncertainty found within the markets. This in itself will help ease some of the worries about inflation and interest rate rises, And this will then hopefully create a more stable economic environment for the invested companies to operate within. Within the UK, we have of course received a change of government, with Keir Starmer resigning and Andy Burnham coming in as the Prime Minister. Now, there are a lot of rumours of what may or may not be changed from both a political and taxation landscape, and we are yet to see what will actually be put into writing and into legislation. Bond markets have started to demand a little bit more interest from UK government bonds, and therefore the yields have risen because they aren't yet sure that the borrowing that Andy Burnham will require will be costed appropriately, and therefore they're asking for a slight premium than they were before he was appointed. However, we will hope that by the time the autumn budget comes around and Andy Burnham puts things into more concrete legislation, that these things will be fully costed, and therefore that premium may drop slightly and return to more normal levels. This is not uncommon, and it doesn't necessarily mean anything about the strength of the government itself. And finally, looking forward, we don't know exactly what is going to happen next, but we can hope that things that are creating uncertainty within the world will start to subside and start to rectify themselves. But fundamentally, as long as your portfolio is high quality and invested in real assets, which is exactly how the Zenith portfolios are all constructed, then you have a very good potential for long-term returns. And it's a case of remaining invested and trusting with the portfolio that the high quality assets will become more valuable over time. I hope that this has been helpful, but if it has created any questions that you want answering, then please feel free to get in touch with either myself, the team, or your advisor directly. Thank you very much for taking the time to watch this video, and I look forward to speaking with you soon. Bye for now.